Inflation sucks. Or maybe it blows. I'm not sure which term is more appropriate here. If, like me, you've got cash sitting in a high yield savings account, it's quietly been drawing down about 1.1% every year, with a really sharp drop off starting around 2021. These days, building up an emergency fund, it's not for the faint of heart. It can feel a bit like, well, serving as target practice for a band of angry post apocalyptic marauders. To me, it often feels like a lot of the money advice out there right now is still tailored to a very different time and a very different audience. It feels like it's coming straight from the 1980s up through 2019, where rates were falling. The inflation of the 1970s felt like a bad, mostly forgotten nightmare that could never recur, and everyone simply assumed the Fed target of about 2% annual inflation would hold forever. Keeping cash around for years just made sense. But now things are a bit different, to say the least, aren't they? I mean, how do I know my cash reserves will even be enough when disaster strikes? Uh, at last count, I think since 2020, we've had cumulative 21% inflation. So, you know, it's as if I only had 75% of what I had back then if I'm sitting on cash. And yes, T bills do appreciate, but not enough to overcome inflation. So, do just keep shoveling money into the money market incinerator, hoping it stacks faster than it burns? Even at a generous return rate of 3.8% APR, that's not enough to get over inflation right now, which is currently ticking at, about 4.8%. And that's money I could have invested into appreciating assets that actually do outpace inflation. I don't want to give up on cash entirely. Don't misunderstand me. I mean, I can't do that. I literally can't. After a lot of thought and research, here's what I'm doing instead: my modern take on an emergency fund build out. But first, a quick disclaimer. I'm not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. My idea to create a better emergency fund started when I came across what's called the Desert Portfolio on optimizedportfolio.com. Yes, I know I have some weird hobbies, but I read these sites over my lunch break. Now, the cool thing about the Desert Portfolio is it is a mostly bond dominated portfolio. In its basic form, it's got 30% to the total stock market, 60% to intermediate term bonds, and 10% allocated to gold. And it's done very well in terms of minimizing volatility and drawdown while still giving investors an okay return. And if you're building a better emergency fund, you're not looking to get maximum gains. You're looking to at least slightly outpace inflation and minimize risk as much as possible so the money is still there if you need it. So you want some growth. Well, I want some growth, but I don't want it to come at the cost of having massive drawdowns right at the worst time possible. And going back from 1978 to July 2021, we could see that the Desert Portfolio's worst year was negative 2.86%. Its max drawdown was negative 10.58%. So not bad. It has a Sharpe ratio of 0.69, and it's returning about 8.91% compound annual growth rate. So that's really cool. Um, my hesitation though with it is that it's linked only to the US stock market, And even in the global formulation of it, it's still linked to the stock market. And typically, I think, an emergency fund comes in handy most often when somebody has just been laid off, the economy is rough. Well, that tends to coincide with periods when equities have really drawn down. So if I'm going to use a portfolio as a enhanced emergency fund, I don't want it to have its drawdown right when I actually need the money. Now, interestingly enough, there is a leveraged desert portfolio take, and this is just a tangent, but it's one thing that I want to emphasize. You can never get something for nothing, right? So, optimized portfolio observes that the leveraged desert portfolio has roughly the same volatility as the S&P 500, but it has a much lower max drawdown. Well, that should have been the warning sign, because volatility and drawdown are very tightly correlated. And so if the S&P 500 has a max drawdown of around negative 50% and the same volatility of another portfolio that hasn't had a drawdown that large, well, one can expect that that drawdown will eventually occur at some point. And sure as shiitake mushrooms, look what happened in 2022. But we're not here to talk about a leveraged desert portfolio, are we? We're here to talk about an emergency fund alternative, an enhanced emergency fund, if you will. So, let's get back on topic. To build the Badlands portfolio, I started with the desert portfolio. And I've run a back test here back to 1991. And you can see that the returns are, they're fair. I mean, if you want to add a comparison here, we can do a global 60/40, which is the most fair comparison. So to see how it compares, it's punching up there with the 60/40, but with a much better drawdown. Problem is, I still think that negative 20% is way too much of a drawdown for an emergency fund. The average drawdown's not bad. The longest drawdown's not bad. The volatility is fine, I guess. The Sharpe ratio is fine, I guess. The diversification ratio is okay. The beta is very low, but can we do better? Well, yes, we can. So, first step to get to the Badlands portfolio is to just take out all investments in equities, all direct investments, that is. Go for managed futures instead, because managed futures tends to bounce during inflationary periods and during deflationary stock market crashes, which is why I really like it as a diversifier in my portfolios. So at this point, we can see that the Badlands portfolio here, and I'll just rename it Badlands Portfolio because I hate the two being there. A little bit of an OCD moment there caught on camera. Anyway, so it's not bad. See how much the max drawdown has been lessened there? The average drawdown is pretty good too. The volatility is much better. Sharp ratios, pretty much unchanged. The thing I don't like about it is it's still dependent on intermediate treasuries. And if the US has an economic hiccup, shall we say, or if we're in a really bad inflationary period, treasuries are going to be a way that, well, a means for the government to accomplish quantitative easing and drain away money instead of putting it in people's pockets. So I don't like intermediate treasuries for this. Instead, I am going to go with cat bonds. And the CBYYX SIM ticker that I've created here is just CBYYX backfilled with the Swiss Re index, having the CBYYX expense ratio applied to it. And CBYYX by construction tends to very closely track the Swiss Re cat bond index. So This will give us a pretty good, reliable gauge of how things are doing. So let's see how that does. So it's looking better. First of all, it's now beating both the Desert Portfolio and the Badlands Portfolio. The max drawdown is even smaller, the average drawdown is even smaller, and the volatility has been reduced too, right? So that's pretty cool. The Sharpe ratio is really good on this. But gold sometimes is flat, right? So I want to add tip bonds, inflation protected treasuries to this portfolio. But I want to do it in such a way that I don't have to replace anything else. Well, Wisdom Tree has provided just the product, GDT. And that's 90% tip bonds with capital efficient layering of 90% gold, uh, secured through futures contracts, which also makes it a pretty good pick for a brokerage account, in my opinion, because when taxes come into the picture, well, the taxes on future contracts and such are more favorable than the collectibles tax on holding spot price gold. So, bit of a two grade upgrade there. So running again, let's see how that changes things. So we've gotten a little bit better return now, about the same max drawdown, the same average drawdown, the same longest drawdown, comparable volatility, and a good Sharpe ratio there. Now, one thing that the Desert Portfolio hasn't done, and now that I've got new assets involved in this, is I want to look and see if this is actually an optimal allocation. Is it still good to have 30/60/10? Well, there's only one way to find out, through the portfolio optimizer. So, what we're going to do here is go over to the sidebar, go to a portfolio optimizer. We're going to put in our tickers. So we've got DBMF we've got CBYYX and we've got GDT And this is going to give us, about 25 years of history to work with. And we're going to do risk parity, maximize compound annual growth rate, and see what we get. And we're going to use historical values and go ahead and run the optimizer. So we see that the optimal allocation is pretty darn close. We're going to freeze the leverage, though. It wants to lever it up to 3 times. We don't want to do that. This is an emergency fund. But it doesn't change the allocations, actually. So it's recommending 27.77% in DBMF. CBYYX, it recommends about 58%. And GDT it's recommending about 14%. Now, one thing that I see some people on YouTube do is they'll run an optimizer algorithm and they'll just take these weights and say, hey, these are the optimal weights. That's overfitting. So we're not going to overfit on our model. What this is really telling us is that, yeah, CBYYX is about right at 60%. You might want to nudge up GDT and you might want to lower DBMF. So that's exactly what we're going to do. We're going to come back over to our back test and we are going to now create another version of the Badlands portfolio. This one with 25, this one with 60, and this one with 15 and GDT. And then go ahead and run it again. And we've got a decent increase in return now with about the same max drawdown, um, about the same average drawdown, same longest drawdown, and comparable volatility, right at about a even 5%. Sharp ratio is the same. Sortino has increased a little bit, and we now have a beta of exactly 0. So this thing is not correlated to the stock market at all. And this is what we are going to make our canonical Badlands portfolio. And just to show you how it performs, I'm going to add it here. Add an asset, the S&P 500, and the total world market as you know comparables. And then I'm going to add the classic 60/40 portfolio global version of it so that you can see how it does. So here we go. See, not bad. In fact, the Badlands portfolio is outperforming the traditional 60/40, and it's doing it without any direct holding on stocks at all. Now that's intriguing. But what about the elephant in the room? What about taxes? And how does this perform relative to cash in terms of risk? So I'm going to set up a realistic scenario here, starting an account at $1,000 with $25 being added on a weekly basis. I went ahead and extended the back test here so we can get some more deep, rich history on this. And so on the left, I've got the Badlands portfolio construction, and on the right, I've got a federal money market simulation, which is just going to be 1 to 3 month treasury bills. So let's see how things pan out with this back test. Sometimes testful.io takes a little bit more time to run on Saturday. I don't know why. Maybe I'm not the only person using this on my Saturday mornings for entertainment. Anyway, looking through here, we see that over the past 19 years, the Badlands portfolio has come in with a compound annual growth rate of about 7%. Same with the money weighted rate of return compared to the federal money market. And it looks like, it's really cool here. I mean, the Sharp for the Badlands portfolio is 1.05. For the federal money market, it's negative 0.21, so not that great risk adjusted returns. But the really fun part starts when you adjust for inflation. So if you adjust this for inflation, notice what happens. The federal money market looked like it was kind of a good deal because at least you're staying steady and keeping on top of things. The problem, though, is when you have purely cash holdings over a long amount of time, and hopefully you're not going to be dipping into your emergency fund frequently, then as you can see, you're bleeding about negative 1.1%, negative 1% every year. Whereas with the Badlands portfolio, um, even after inflation, it's around 4%. And look at the max drawdown here. So before accommodating for inflation, it looked like the Badlands portfolio at about 6 to 7% max drawdown was way more risky. But when you factor in inflation, you're actually looking at a max drawdown on a federal money market account over the past 20 years of about a quarter of the money put in. And the drawdown has lasted from that initial amount for the majority of the 20-year span. So 17 years compared to a maximum drawdown of negative 9%. Let's round up negative 10% with longest drawdown of 3 years for the Badlands portfolio. And the Sharp ratio shows that it's a much better risk adjusted return here. The diversification ratio is really good. I mean, the beta is 0.01, so the Badland portfolio is almost totally uncorrelated to the market. But I did say I was going to talk about taxes. So the cool thing about testful.io is it's got a little turnover and taxes table. So we're going to see what this looks like with the short-term tax rate, the long-term tax rate, and then I am going to actually change it to the top bracket for ordinary income, which is 37%, and show you what it looks like there. Because other than managed futures, a a lot of this portfolio is going to be taxable at an ordinary income rate. Um, Now, a lot of people are a little bit hesitant to have ordinary income rate funds in a taxable account, but for the purposes of the Badland portfolio, I'm not too worried about it because, well, cash is also taxed at the ordinary income rate. So if we're building a better emergency fund portfolio than cash, well, anything that's earning more than cash and has reasonable stability is still going to outperform even after that ordinary income rate. So let's look at the Badlands portfolio. We see some taxable events from the turnover there. We can look at the after-tax performance, and we see that before tax with cash flows, we had about $40,000. After tax and cash flows and tax on those cash flows, it's down to 38,489. So that's really not bad. It's paying Uncle Sam about, um, you know, uh, give or take $1,500 over a 20-year period. And you can see that the compound annual growth rate really hasn't been impacted that much by taxes. If we racket things up to ordinary income, which I mean, we really should, because this is an ordinary income portfolio, and I'm taking the highest tax bracket imaginable, 37%. That's the top. That's for married couples who are making like I don't know, $780,000 a year, and single people who are making $550,000. I'm not in that bracket, and I'm sure a lot of my viewers aren't either. But we're just going for a worst case scenario here because maybe you live in California and there's other state taxes, etc., to take into consideration. So after tax performance here, you're paying Uncle Sam about $2,700 over that 20-year period. And if we look at the base performance, then your compound annual growth rate goes from 4.44% to 3.97%. Now, what if I was looking at the federal money market, right? Because that's taxed at an ordinary income rate too. Um, so after tax performance, so federal money market, this is assuming that you are not, paying any state taxes. That's not true. But federal money market, it's cool because you don't pay taxes on that. And that's important to emphasize. But, and this is the big but, you're still looking at that negative compound annual growth rate. So the question boils down to, do you want to pay more taxes and actually have positive net return? Or do you want to avoid paying taxes and actually end up with less purchasing power in the end? I'm actually not opposed to tipping Uncle Sam if it gets me in a better financial spot in the end. So instead of using cat bonds, would it make sense to use intermediate treasuries or long treasuries or maybe high yield municipal bonds instead? Especially for people in, places like California? Eh, let's find out. All right. So again, we're looking at returns after inflation here. So we've got our Badland portfolio variants, the original one, the one with the high yield tax exempt bonds, the one with the intermediate treasuries, and the one with the long treasuries. Now, if we look at this, we could see that the original Badlands portfolio with cat bonds is by far the smoothest ride. It's right in the center of the distribution in terms of returns for most of its history. But when inflation strikes, it has particularly good performance. The Badlands portfolio with long treasuries had a lot of volatility, but also had the highest return for a very long time. But again, that's only going to be true for environments where rates are being cut. Myself personally, I'm more of a I'm more of a floating rate kind of guy because I don't know if inflation's going to go up or down. And that's a reason why I particularly like cat bonds because cat bonds layer the risk premium of reinsurance on top of the ordinary returns of short-term treasuries because that's where they park the collateral in the meantime, in really a federal money market account. So it's kind of a leveraged play, if you will, without any leverage. You're getting the returns of cash plus the returns of the reinsurance premium. So it's kind of a indirect way of capital efficiency, I suppose. But in any case, it's the smoothest ride. And when I'm looking at what I want in an emergency fund, I'm looking for a smooth ride. I mean, the bonus is that it just so happens to end up with the highest amount after inflation. But what's really attractive here is look at the max drawdown on this. It's still at right under 10%. The other options here are a lot higher. The average drawdown is really good. The longest drawdown is the best of the bunch. The volatility is, it's right in line with the Badlands portfolio with the municipal bonds. It's interesting that the Treasury options actually have a lot higher volatility, and the risk adjusted returns are great. So, uh, that's the way that I want to go for my own uses. Um, Again, I don't mind paying more taxes if it means that I have more money left over in the end than a more so-called tax efficient strategy here. Uh, and I'm just trying to build a better emergency fund for myself. And well, even with with a federal money market account, I wouldn't be paying taxes, but with other money market accounts, I might. It's just a question of you know, do you want to avoid taxes or do you want to actually make money? I tend toward the latter. Thank you so much for watching Miller Momentum. Hey, if you enjoyed today's video, don't forget to like and subscribe. Even if you didn't enjoy today's video, like and subscribe and give me grief down in the comments. I appreciate feedback from my viewers. I love interacting with you all, and you've got some pretty cool ideas and questions you toss my way. I do want to say that I'm aware of the situation with Snowball Analytics. It's not really displaying my portfolios anymore. I'm still tinkering with that. Once I get it back online, I have been advised to actually hide the exact values, monetary amounts of my accounts, but I I'm looking into a way to show the returns and all of the statistics because ultimately that's what matters because anybody who goes with these strategies, they're not going to have the exact same amounts that I do in these accounts. And the returns and actual performance in the abstract are really what counts. So I appreciate your patience while I work through those technical difficulties. I apologize that I'm not really going to be able to display the exact account balances anymore, but I'll make it up to you by displaying more strategies, including the actual performance of my new Badlands portfolio, the actual performance of my Roth IRA, the actual performance of my retirement accounts. Um, you'll have all the percentages and everything ready at your fingertips on YouTube's channel page for my channel. Um, Fingers crossed as soon as I get these technical glitches resolved. I'll catch you next time. In the meantime, keep on rolling with Miller Momentum.